Hello, thanks for tuning in. We are on the last segment. As always, the last segment is always Q&A on selling, buying, but this week it's all about property investment. I have here with me my good friend James Ong. He is the director of Fortis FB Consultancy to tell us more about property investment. Okay, James, there are a lot of people who's interested to make money out of their assets, would be their property. So, who would you reckon be the most apt person to have this investment for their property?
A lot of people, when they buy property, they just say, I want to buy property for investment. Actually, the true definition of buying property for investment, number one, you must have spare cash. Very simple. You have really take care of your family bills, you take care of your commitment, you're taking care of the house that you're staying, you take care of the lifestyle, whatever it is. Then when you have extra money, then we talk about investment. So investment is, property investment means you don't buy your first house for property investment. You buy because you already have surplus cash. That would be the people who have extra money thinking, you know, I've got extra money. What do I do with the money? Do I buy this? So investment, there are different asset class. Means different type of investment instrument. So property is one of them. So people who have extra money, they do normally invest in property.
But I guess that would be, you know, the number one rule of thumb when it comes to investment or investing in anything for that matter. You need to have the extra cash, then you would only invest, correct?
True.
Okay. So what are the things that one should consider if they have the extra cash? You know, they would want to have a property investment, buying to invest. So what should they consider?
In any investment, the reason why you invest is to make money.
Correct.
You want to profit from the investment. For property, it's very unique and very interesting because a lot of people, when they buy property, they expect, let's say, after a certain timeline, the price of the property will increase. This is basically called a return on investment, or what we call simple term again is capital appreciation. And of course, when people actually buy property, they'll find a way to pay for the property. So in most cases, people say, okay, I'm going to buy a property to invest. How do I pay for it? I'll take a loan and I rent out my property. So I'm investing, you know, I buy a property then I get somebody to come and rent it. So when I rent it, it's actually a cash flow. So in that sense, you basically have taken out something and invest in it. And with the rental that you collect from the tenant, it becomes a cash flow. You pay for your investment. So investment is basically continuing in the sense that after 3 to 5 years on a short-term, mid-term basis, you sell the property, you make money. That's how you basically call investment return.
And then we know what market value is from last week, but we need to know what is BLR. And then there's also, you know, words spreading around saying that one should not invest when the BLR has increased or appreciated. So what's your say on this?
First, we define what's BLR.
Correct.
BLR stands for base lending rate. So basically, a base lending rate is an interest mechanism that is in the financial market. At present, most of the banks, they can fix their own BLR. It ranges at the present time between 6% to 6.3%. So in other words, a lot of housing loans, they always take the BLR. For example, Bank A will say, okay, for the first 3 years you take my loan, BLR minus 2.5%. So the BLR is actually 6.5% or 6%. You minus that rate. So basically, banks use it as an instrument to basically package the housing loan. And to your second question of, in case the BLR goes up, do a person continue investing? This is a bit subjective. It depends on the objective of the investment. When BLR actually goes up, means the cost of fund, means the financing costs are actually increased. In general cases, when cost of funds goes up, means you have to pay more. The installment will be increased. So if you have a property that you invested, and if your installment is still is on the increase, but your rental it is not. So in other words, your cost of fund, you have a little bit of pinch because the amount that you collect from the rental is unable to pay for the bank installment. So in general cases, when BLR goes up, there are certain market or segments you will be quite sensitive. But if there is a property which is very, very high potential in capital appreciation, and if you are able to get a capital appreciation much higher than the effective rate of the finance cost, then you will actually get a positive return. Means in other words, if the BLR goes up and you can still able to catch up with the return of your investment, why not? So this is based on case-to-case basis and the type of properties that one invests in.
And I'm sure the viewers out there have heard a lot of note exchanging on property investment, how easy it is for you to make money out of your asset, and how easy for you to invest on your property. But in actual fact or in reality, is it as easy as it seems for a person like me, a normal, typical person who has, very minimal experience and very minimal knowledge on property investment to actually start, in property investment?
For generally an individual, when you buy a property, you find that it's a bit, the quantum is not too much, it's quite safe. Then when you invest it, the risk is not so high. A lot of people now buy properties because there's a market for housing. A lot of people come to the city, they need housing. So the market for housing capacity is always there. So for people, if you were to buy something which, at the end of the day, you know very well, you look up at night to the property, you know all the lights are on, means a lot of people is buying for housing. But if you're just buying a property and you want to make money, and if the property is not that small amount, it costs you maybe a few million, it is wise to do homework, ask around, maybe get a professional. Then you have to do some calculation, whatever it is. Because when you buy a property which is on the middle to high end, there's a risk. The risk in the sense that if you buy the property, you're unable to service the bank. You still have to pay for the interest, because the bank will still charge you, you have to pay the installment. So some of these things you have to consider. So on certain things, if you can do it yourself, do so. You can't just get professional advice, because it has to do with money, and you have to make wise decisions in order to make money.
All right, thank you so much, James.
Thanks, Lina.
And if you want that wise decision and wise advice, don't be shy. Come over to Menara City Bank. You can look for James Ong. He is the director of Fortis FP Consultancy. And until we meet again next week, that's all for me from In Realty. See you again next week.